In the 1600s, the Dutch East India Company employed hundreds of ships to trade gold, porcelain, spices, and silks around the world. But this major operation wasn't cheap. To finance their expensive trips, the company turned to private citizen individuals who can contribute money to support the trip in exchange for a share of the ship's profits. This allowed the company to make extensive trips, increasing returns for themselves and their knowledgeable investors. These shares were sold in the coffee houses and seaports of the continent. The Dutch East India Company unknowingly created the world's first stock market. Since then, companies have raised funds from interested investors to support businesses of all kinds. And today, the stock market owns schools, careers, even entire television channels dedicated to understanding it. But today's stock market is more complex from its original incarnation. So how are companies and investors using the market today? Let's imagine that a new coffee company decides to launch in the market. First, the company will advertise itself to large investors. If they think the company is a good idea, they get their first crack at investing, and then supports the company's initial public offering or IPO. This drives the company into the public market, where any company or person believes the business can be profitable can buy a stock. By purchasing a stock, those investors become partial owners of the business. Their investments help the growth of the company, and as it becomes more successful, more buyers see the potential and start buying stocks. As those demand increase, so does their price, increasing the cost to prospective buyers and increase the value of the stocks already owned by the members of the company. For the company, this increased interest helps fund new projects, and it increases its overall market value by determining how many people are willing to invest in their idea. But if for some reason a company starts out looking unprofitable, it can also be the opposite. If investors think their stock price is falling, they will sell their stock hoping to make a profit before the company loses significant value. As the stock is sold, the demand for the stock decreases, the stock price goes down, and with that, the market value of the company. This can leave investors with big losses, unless the company starts to look profitable again. Many factors affect this seesaw of supply and demand. Companies are under inevitable market forces, such as price fluctuations, changes in industrial production, and shifting cost of labor. Investors may be concerned about leadership changes, bad publicity, or big things like new laws and employment policies. And of course, many investors are just ready to sell stocks and pursue their own interests. All these variables create daily noise in the market, making companies appear more or less successful. And in the stock market, appearing to lose value often leads to losing investors and in turn, losing actual value. Human confidence in the market has a driving force everything from boom to recession. And this difficult to track variable is why most professionals promote reliable long-term investing over trying to make quick cash. However, experts are constantly developing tools in an effort to increase their chance of success in this unpredictable system. But the stock is not just for the rich and powerful. With the launch of the internet, everyday investors can buy stocks in as many positive ways as a great investor would. And as more people educate themselves about this complex system, they can also trade stocks, support trusted projects, and achieve their financial goals. If you found this video helpful or enjoyable, please consider hitting like button and subscribing to my YouTube channel. By doing so, you will stay updated with more valuable content like this. Thank you for watching, and I will see you next time.